Go ahead and mute yourself now. But we're going to go ahead and get started here. Welcome to the first official mortgage update of the year of 2025. And it's what I'm going to do today is kind of go through what's happening with the markets, why things are happening, what the forecast is, and really dive into the details behind it so you guys can really have a good grasp of how to portray this to your buyers and sellers that are out there that are looking for their next home. So let's go ahead and jump right in. So first off, here's today's rates. Now, we were down to almost 6%, even below 6 at one point. I'll show you the mortgage-backed securities trend in the graph to kind of see where we were and where we are now. But 30-year fixed, we're creeping up on the 7.25 rate. Again, remember, this is based on really good borrowers. So if you have borrowers with a conventional loan that are in the 680 credit score, or it's a condo, there's going to be some loan level adjustments that are added to this. So this is just an average and based on the parameters of 250 loan amount or more, 30% down, primary residence, single family detached home. So actual interest rates will vary depending on each individual person's circumstances, but this is kind of a good idea where we're at. So 15 years in the mid sixes. ARMs, as you can see, are very similar to the 30-year fixed. Jumbo's a little higher. We actually have some jumbo options that are lower than this, but then some are much higher. So the average tends to show a little higher, but there are some 30-year jumbo rates that are right on par with the normal 30-year fixed. And then we have VA and FHA, which are always tend to be a little bit better than a conventional loan. So as you can see, rates are going up. And why? Like, what is happening? Well, this is the history of the mortgage-backed securities for the last year. So if you go back to January of last year, we had a dip down. They lost their value, which means mortgage rates went up. And then down here, if you remember, April of 2024, we were in a bad spot. I mean, rates were close to 8%. It was pretty ugly down here. We went into this no man's land of this giant spread here where the rates really have no levels of resistance. These black lines, there's no black lines here or levels of resistance. So we just went up and down and it was pretty ugly. Then we regained ground and we got up to here, and up here is where we saw rates right around the 6% range. We tapped onto this level of 102.5 and we couldn't quite break through. And then it's been a free fall. We saw a little rebound. And then this last couple months, from middle of November to now, we've been on pretty much a free fall on the value of these mortgage-backed securities, which means rates spiked. And now we're in this no man's land right here. If you look, we're in this range. So I'm hoping and praying that we do not go any lower than where we are right here, because this is a dangerous space to be in, because as you can see, there's a lot of movement here. So we've seen a pretty rough dive, so to speak. And I want to show you something really interesting, because this is the 10-year. Now, the Fed's cut the Fed funds rate by 50 basis points right here. See where I'm moving the mouse around? And the 10-year screamed upward. Now, when the 10-year goes up, so do mortgage rates. So you saw the Fed cut here and cut again 2 more times, and the 10-year screamed higher. Now we're above this 4.735 range. We're above this, and we are in this no man's land. So we could see it go all the way to 5, and that's what they're afraid of, I guess is the best word for it. We do not want the 10-year to go to 5, because that means if we go backwards a little bit, if the 10-year goes to 5, that means the 30-year can go all the way down to the 98.87 down here, which means mortgage rates could lose an extra 100 basis points or so in pricing, which is not good for interest rates. We would creep up on the high 7s and close to 8 at that point. So we don't want this to happen. It's really confusing for consumers right now, because they're hearing the Fed's cutting rates, they're hearing all this, but then they're seeing the mortgage rates go up, and there's a lot of confusion. So keep in mind the Fed funds rate is very short-term money. That's credit cards, home equity lines that vary every month. Mortgages are fixed for long periods of time, 30 years. So they're different. They're the inflation numbers, the jobs numbers, all of that. These short-term numbers, they don't affect long-term fixed rates. So it's very confusing for consumers. So why are these mortgage rates going up? The Fed's cutting rates. They're cutting rates to stimulate the economy. Okay, so hear me out on this. We saw kind of some weakness in the economy. They raised the rates to slow everything down. Well, when the economy starts to slow down to a point where it could be put into a recession, the Feds want to loosen things up again to get the markets flowing again. Okay, so the Feds are now stimulating the economy by cutting the interest rates, making money a little cheaper. And they also want to stabilize the jobs market because the unemployment rate was creeping up. So now they're doing that. They're cutting the rates to do that. And they want to keep inflation low. So what's happened the last couple months is that the current data that is being shown and what's happening is that inflation is sticky and stubborn. So now the inflation that's being reported right now, it may be overstated because there's a lag in some sectors, and some of the sectors that come into the overall numbers that we calculate for inflation have a really heavy weighting. Like housing is 41% of the total CPE. So that number has a huge impact on the overall inflation numbers. And then also the job market is much hotter right now than they expected. And I'm going to get into that. Is it overstated? We talked about the BLS jobs numbers a little bit in the past. And then inflation is kind of ticked up a little bit. But is that because of shelter? So we're going to look into that right now. So the current market is showing a hotter economy. And what does the Fed like to do when there's a hot economy? They like to raise rates. Well, what's happening right now is the Feds are seeing what's happening. They're seeing all the numbers and they're like, whoa, we can't cut anymore. They were projected to cut up to 150 basis points more. Some Feds are saying that they don't want to cut at all anymore. So it's going to be interesting to see how future data catches up. But right now, this hotter than expected economy, this hotter than expected jobs market, this higher than expected inflation is causing rates to kind of scream back up again because it's telling us the markets are too hot, which is inflationary. So we need to be really careful. And we want to really see what the real numbers are. And that's going to be coming out in the next couple of months. But current market data indicates potential for fewer Fed cuts in the future. So interesting. We'll see if they're wrong and see if they have to do a quick oops and do a 50 basis point cut in the future. But that's kind of what's happening with jobs. So with rates. So let's look at the jobs numbers. So the BLS jobs report, the Bureau of Labor and Statistics, they came out. And if you look at the jobs, their last reading was that there was 256,000 new jobs. They were estimated to be 160,000 new jobs. This is for the month of November. And there's a seasonal adjustment of 81,000. There was a 2-month revision down of 8,000, but this number 256,000 was 100,000 more than expected. Now, those jobs came from 33,000 were government, 46,000 in healthcare, 34,000 in education, and then 43,000 came from leisure and hospitality. Now, keep in mind, the BLS jobs numbers, they were off by 1 million jobs last year over a 12-month span. So that's almost 100,000 jobs a month they were off by. Once the census comes out with numbers in February, we're going to see if these numbers are wrong as well. But the past dictates the future, right? Past behavior can dictate what they're going to behave in the future as far as the BLS numbers being wrong. Most likely these numbers are inaccurate. But when this number hit, the bond market lost 50 basis points in mortgage on the mortgage-backed securities and that is a huge hit for one day. Now, when these are adjusted, we never see any response in the mortgage-backed securities. So it hurts us and never helps us when they're revised. So it's really frustrating to me because the jobs numbers, I believe, are actually worse than what they're saying. But let's dissect that a little bit. So the unemployment rate, oh, this is the household survey, by the way, which is what it sounds like, a household survey. Like, do you have a new job? There was 478,000 new jobs created in November. I was really high. So unemployment rate is now 4.1. So the unemployment rate dropped. Now that's the household survey, which is really interesting. But unemployment people in unemployment are actually lasting longer. They're staying longer on unemployment. So if you look at the range of how long people are staying on unemployment from November to December, it is going up. So that's an interesting stat. And if you look back in December 2023, it's higher than there. So people are staying on unemployment longer. And look at this. These are the jobs that are being created. 24 and under, there's 359,000 of the 400,000 were there. And between 16 and 19, 224,000. So the jobs that are being created are for young people, which a lot of times they're part-time. Look at these part-time jobs. Of those numbers, 247,000 of them are part-time. So when you look at the labor market and you look at a part-time, there's no way to decipher if it's that person's primary job, and that part-time job is somebody different. So it could be somebody with a full-time job getting another part-time job just to afford life. But there's no way of knowing if that part-time job is that person's only job or if they have two jobs. So the numbers are kind of funky. The markets look at it like, oh, it's another person getting a job. But that could be another person with a full-time job getting a part-time job. So, or a lot of kids getting part-time jobs and that might end because remember, this was before the holidays and a lot of part-time jobs came in before the holidays. So it's really interesting. It's really skewed. It's going to take some time to really see the true numbers. And also the average hourly earnings, that is lower than it has been, which is really, really good. So when inflation was a problem, earnings were going up tremendously. I mean, you saw like Jack in the Box, they're saying hiring at $18 an hour. Well, that wage increase, the hourly earnings increase was really high. We're seeing that come down below the normal, which is really good news for inflation. So that's some positive. So what will mortgage rates do now in 2025? That's the magic question, right? Like, what will they do? Well, I guarantee you they're going to change. I know that's stupid, but they will change. They will go down. They will go down. I promise you that. But here's what the feds are saying. A lot of the Fed members are saying that the number of the percentage range of unemployment is going to be down between the 4.1 and to 4.3. These are the number of people that believe that the unemployment level will get to these levels. Well, we're already at 4.1. Most of them believe we're going to be in the 4.2 to 4.3. But if unemployment range gets to 4.4 or 4.5 or even 4.6, none of the Fed members, none of the participants in the Fed think that the unemployment rate is going to get to 4.4 or 4.6. If it does, that's going to be a shock to them. And that's going to be one of those things that they're going to say, oh my gosh, we need to cut the Fed funds rate now more and faster. So it's going to be interesting to see what the Feds do based on the unemployment numbers. If they continue to go higher, then they may not cut at all. But if the unemployment range, which is expected to rise, continues to go higher than they expect, then they're going to be shocked. And that could bring in a surprise where they can do some emergency cuts at some large amounts. So let's look at inflation. So 2.8 year over year as of November. That's not bad. Okay. Shelter, again, 18% of the core. Shelter is at 4.8 year over year. That's really, really high. So that's a big part of the core inflation number. CoreLogic has it at 1.7 year over year. So there's a big discrepancy there. There's a 3.1% overstatement of shelter. So we're going to see inflation come down because of that, because it's a lagging indicator. Right now we're at 1.7. The 12-month average is 4.8. We're 3.1% overstated. So inflation numbers are going to come down, which is going to really help interest rates. And we could see the CPE come down to about 2.3 based on this shelter. But right now there's a lag, take some time to get there. But here's the numbers that we're going to replace. So if we're really low right now, the last year, a year ago, the shelter was 0.514. So if we're going to replace that big number with a low number, it's going to really help the overall inflation numbers. And when you hear, hey guys, new inflation numbers are out and they're at this number, it's because we're replacing this big number with a new smaller number. That's going to be very, very helpful to mortgage rates. So do I think that the inflation numbers are going to come down? Yes. And do I think that's going to help mortgage rates? Yes, I do. So here's the cumulative inflation though. People always hear inflation is coming down. What does that mean? That means the rate at which things increase is slowing. Prices are still going up, but they're going up in a slower fashion. They're going up more slowly. So if you look back in 2020 to the middle of 2023 or 22, the rate at which the inflation was going up was dramatic. But when the rate of inflation was going down, the overall inflation is still going up, just at a slower pace. So we want the inflation to follow the GDP. We want the inflation to follow the nice average in the twos, right? We don't want it to spike up like it did, because that creates problems. Now, seeing this graph spike way down is great, but the damage is already done. Prices are already higher. And notice there's no reversal in the overall trend of this trajectory. The cumulative inflation, there's no down spike. There was a small one here, but overall inflation just keeps going higher. So when people say inflation's coming down, the rate of inflation is coming down, but inflation is still going up. So interesting to look at. So labor forecast, we are expected to see the unemployment rate to rise, even though the data is saying that jobs are coming in higher. Just wait and see. I promise you, wait and see. There's a question here. What do you think is going to happen first? Interest rates will drop to below 6, or sellers will start to significantly lower their asking price? Good question. I believe that's more of an emotional response to what's happening with their specific properties. Some properties are selling fast, some aren't. It's going to really be interesting to see how the sellers respond to this. The fewer the amount of buyers because of higher rates, the more apt the sellers are to lower their price. But if it's a really good home and maybe the seller's willing to give a little in concessions, maybe you don't have to lower the price. So it's going to be that's a very interesting question, Michelle. So let's look at the unemployment. Look at that 21 increase in the last 7 months for the duration of unemployment. So people staying on unemployment is going up. That is a sign of that's a negative sign for the economy, which could be good for mortgage rates. And check this out, guys. When they say all these new jobs are coming in, look at the amount of businesses that are closing, how many stores they're closing. Party City, everything there is 75% off. So if you have a birthday coming up, go to Party City. It's 75% off right now at the local Party Cities. 850 are closing. Big Lots, 580. Family Dollar, 700. CVS, 900. Advanced Auto Parts. I mean, look at the number of these stores closing in 2024. We're up 70% compared to 2023. So when they say the jobs market's strong, this kind of paints a different type of a picture. So where are those jobs? Who's getting those jobs? It's really interesting to see the movement and where these companies are going. It's really interesting. So these are the jobs openings. Now, JOLTS, the jobs opening labor is really an interesting number, because job openings right now, and I want you to understand this, these are the jobs that are currently available. Now, if I am hiring now, and I need a job for somebody to do some clerical work, or to be, maybe they're doing some accounting for me, I don't really care where they are anymore. So they can work remotely. So what am I going to do as an employer? I'm going to post that job, and I'm going to show it's available to all 50 states. Okay, follow me. I have one job, but I'm going to show it available to all 50 states. Now, on the job openings report, each state is reporting the jobs that are posting for their state. So if I have one job and I'm posting it at 50. JOLTS report is going to show that as 50 job openings. So that job openings is skewed because of that. Really interesting. So when you see all these jobs are available, you're like, well, why aren't all these people working? There's tons of jobs available. How come the unemployment is where it's at? That's one of the reasons. So really, like I said, the way we take our data in this country, the way we present our data, the way we calculate and gather the data needs to be completely reset. That's just my opinion, but that's where we're at. So where are we at with the 2025 rate? We have a target rate of the US Treasury or the 10-year Treasury. The target for this year is expected to get down to 3.6. Now, right now, we're scooting up to 5. So this is not a good trend. So the target we want is 3.6. That's where everyone thinks it's going to go. So what does that do for mortgage rates? Well, there's usually a spread between the 10-year and the 30-year fixed mortgage rate of about 2%, roughly 2 to 2.5%. So what does that look like? Well, right now, we have a huge spread. In October, we were a huge spread between the 30-year and the 10-year. We want to get that down to where it's below 2 and 2.5, right around there. So what does that mean for interest rates? That means we should, in the future, what the target is, where they expect it to go, should be right around the 5.85 if we're a normal spread over the 10-year Treasury. What does that look like? A Fannie Mae rate of 5.875. Now, will we get there? That's the target. Will we get there and stay? That's a question mark. We kind of got there a little bit last year, or this past 2024, for like a week, right? Everyone was excited, and then they started shopping, and then rates spiked up again. But that's where we are looking to be, and that's where the future rate projections are. That could be very good for real estate. So mortgage real estate forecast, home appreciation, we're still supposed to be in the 4% range. Now, this is nationally. So there are some pockets that are kind of soft. There's some pockets that are screaming hot. So it just depends on where you are. CPE inflation is supposed to go down to 2.1 to 2.2. This is going to be really good for mortgage rates. Unemployment rate supposed to go up 4.5 to 4.6. That's going to shock the feds, have them cut the Fed funds rate a little bit more aggressively. And Fed funds rate should be between the 3.2 and 3.5. Mortgage rates should decline to the 5.75 to 6. Now, right now, we're right around the 7.25, so that's a pretty big jump. Expected maybe 6 months from now is where we'll be on that. So we could be in a really good position to see some pretty significant changes over the next 6 months. But right now is kind of ugly. We need these numbers to catch up. We need the numbers from the census to come out to show the true employment picture so that the markets can really catch up to themselves. So that's kind of where we're at right now. I'm going to open up. If you guys have any questions, raise your hand at the bottom, or you can just speak up. I think I've unmuted most of you here. Everyone has the ability to chat if you want to jump. Okay, we got a question, Michelle. You can go ahead. You're unmuted. Go ahead and what's your question?
Okay, so I've heard like that the conservatorship of Fannie and Freddie is ending. Is that going to affect us?
They've been talking about that for years and years and years. Probably not. So if it does happen, that could be a good thing. But if it doesn't happen, really what's happening in real estate and the rates are a functionality of something separate from that. Okay. Could that loosen some guidelines? Could that make things a little bit more tighter? That's another question all to itself. But as far as interest rates, it shouldn't have any impact on that. Good question. Any other questions?
Sean.
And wait,
it's Joyce.
Joyce, you got a question?
Yes, I do. So for our clients who are still coming back at us, like, you know, the rates are too high, this and that and the other, I'm pretty sure you probably have a lot of products that might make it less painful for them to jump in now. Do you have any wise words for us on that?
Yes. As you saw, the ARMs, the adjustable rate mortgages, were slightly better, but very slightly. Not a huge jump lower in rate to get an ARM, but we do have the 3-2-1 buy downs, the 2-1 buy downs, the 1-0 buy down. We have a lender paid 1-0 buy down. Those are temporary rate buy downs. They buy you some time so that when you can refinance in the future by getting you a lower rate. Those are only seller paid, except for we have an in-house lender paid buy down of 1% below the current market rate for the first year. And then there's the permanent rate buy downs as well. Very popular, guys. I spend most of my time now helping buyers that are getting pre-qualified understand how the buy downs work and how to strategize in the offer process. This weekend, I spent hours going over different scenarios on offers because they didn't like the payments that are associated with current rates right now if they made just a normal offer without concessions. So lots and lots of buy downs. You can see this with the builders. They're offering that and they're advertising lower rates just to get people to bite. So yes, there are lots of products, but we need the sellers to participate. So if you have listings and they're sitting, have a conversation with your sellers that this is going to be very important to have options for buyers to get a lower rate to try to move the properties that are out there right now. So it is slower because rates are higher, but once rates do dip, it's going to be a different market. So we got to keep that. How about grants and DPAs? Yes, so grants and DPAs are still available, but keep in mind, nothing in life is free. So these down payment assistance programs typically have a little bit higher interest rates, plus they're a little bit more strict on the underwriting guidelines. So a lot of times, those first-time home buyers that are looking for those down payment assistance programs are a little shell-shocked by how much they can qualify compared to a normal FHA loan or by the rates associated with them. We do have some that don't have any adjustments to rate, but they do have some golden handcuffs where they can't refinance in the near future. And if they do owe some of that money back that they got. So good question. So remind me how much it costs seller to buy down. Great question. Seller buy downs, they depend. You could buy the rate down an eighth, and that could only cost $1,000, or you could buy it down by 2 full percentage points, which could cost, $20,000. The cost of buying a rate down is a percentage of the loan amount, and the lower you go in rate, the higher the percentage increases on how much it costs of that loan amount. So it's not a given dollar amount that you can calculate. It really depends on how much the loan amount is and how low you want to go. So you can't really say this is how much it costs to get the rate to here, because it's going to be different for everyone. But the more you go down, the more it's going to cost you. So good question. If you have any specific scenarios you need help with, I'm happy to present those and show those to your buyers. But very good question.
Sean, it's Melissa Gasper. I have a quick question about the rate buy downs.
Yes.
So last year you were really saying like it wouldn't make sense to do a permanent rate buy down as much as it would to do the like 2-1 or 3-2-1 or one of those temporary buy downs. And it sounds like maybe your opinion on that has changed. So I'm not sure if now it's like half a dozen of one to the other or whatever, of which way you go with that. Are you still thinking it's like better to do a temporary rate buy down and then have the option to refinance later and not spend all that money initially?
That's a really, really great question. And you know what I found out? That's my opinion, because if 6 months from now, rates are at 5.875 and you just spent $20,000 to permanently drop it to that.
Right.
How much did you save per month? It might have saved you $250 a month, and you did it for 6 months. So that's what, $1,500. It saved you over 6 months, but you spent 20 grand to get it. Here's what I'm seeing. And this goes based on this kind of plays into the fear of the consumer. I'm presenting the permanent and the temporary and telling everyone how that works. So when I'm presenting that, they're saying, well, you know what? I don't know what the future, the government, everyone has been saying mortgage rates are going to be lower for the last 3 years. And they're not. I don't believe that anymore. So I'm just going to do it now. I don't care. I'm more comfortable knowing what my rate's going to be forever. And yeah, you're saying the rates should come down, and maybe they don't. Who knows, right? The future is not guaranteed. So I would say when I'm presenting this to consumers, 80% of them are opting to just get the lower rate now.
What about if you refinance after you do a permanent rate buy down? You don't get refunded any of the money, right? like
Nope.
you do with the 3-2-1 buy down?
The benefit to the temporary rate buy down is you're not spending that money up front. You're getting that money's sitting in a little piggy bank. And every month you're dipping into that to make, and that's supplementing your payment. So your payment should be based on the rate of 7.25. But every month you're dipping into that from the seller to supplement the payment so that your payment out of pocket is equal to a rate of 3% below what the actual rate is. So every month you're dipping into that piggy bank. If you refinance before that piggy bank is empty, you get that money back by lowering the balance on your mortgage. It gets refunded back to you and it just gets deducted right off of your current loan balance. Whereas if you do a permanent loan buy down or rate buy down, that money's gone forever. It's spent, it's done.
But you could buy that yourself and the seller has to be the one to pay for the temporary, right?
Is 100% correct.
Okay.
Yep.
Okay,
So-
thank you.
Except we do now have a lender paid buy down, temporary buy down. That's for 1 year, where there's nothing out of pocket for the borrower and there's nothing out of pocket from the seller. The lender covers it for 1 year. We do have that now. So if there's no money to budge from either side, we do have the capability of getting that 1% below for the first year and having the lender ourselves pay for it. So that's a new product. It's kind of fun. Steven, you've got a question. Steven, do you have a question? Are you on mute? Here, let me see if I can unmute you. No, you should be able to speak. Oh, well, if you have any other questions, I'll see if it's in on the chat. Remind me how much, so I buy down, 2-1 buy down. So the 2-1 buy down it's a hard calculation. The way you calculate it, and this is why it's hard, is whatever the savings is per month based on the 1% lower in rate, that multiplied by 12 months is the cost for that year. And then the next year, the savings per month multiplied by 12 is the cost for the second year. And then the third year, the month savings for that month times 12 is the savings for that third year. And then you add those all up to get the true cost of that buy down. So it's pretty complicated how to actually come up with that number. I have some, in-house calculators that I can use for that. So if you do want to know what that's going to cost, let me know and I can calculate that for you. So if it's a $400,000 loan and the rate is 7%, but you buying it down to 6%, what's the savings on that payment? Multiply that by 12. That's the cost for the first year. That's how it's calculated. I hope that didn't confuse you. How about Grant? See if there's any other questions. Any other questions on what's happening with the market? All right. I hope this was really helpful to you guys. My job is to try to help make sure you guys are armed and with really good information so you can be the best representative to your buyers and sellers. So if you do have anything or need anything from me, please let me know. As you may know, this last 6 months of my life was not easy. I went through the whole cancer thing, went through surgery, and I was trying to have perception that it wasn't affecting me other than the couple of weeks that I went under the knife. But I'm not going to lie, it was a pretty heavy burden to bear, but I am clear. My blood work is clear. Everything's great. So I'm super excited for that. So thank you for your thoughts and prayers there, guys. And I am really excited for this new year. So whatever you need, I am here for you. Thank you again for joining us today. And if you do have any further questions, please reach out to me, give me a call, shoot me a text, and I will be here to assist you. So thank you guys. Have an awesome week, and we will be in touch.
Thank you, Sean. Glad you're doing better.
Thank you very much. I really do appreciate that.